So yeah, just maybe we can do a quick tour of the table and go around and sort of each of you introduce yourself. So Joanna, maybe you do that, and then I don't want to go first. I think maybe I'll go last.
Okay, so I already told you I'm financial inclusion specialist at e-MFP. I joined the e-MFP team in June this year, so relatively new to the team. But before I was working, I was working at University of Portsmouth, and for 5 years I was a researcher there. And most recently, I had the opportunity to work at evaluation of a savings project. So I'm for sure not as expert as most of you in the savings topic, but I will do my best to facilitate discussion and to make the discussion as fruitful as possible. So.
Joanna, why don't you call out the order, since otherwise it's going to be messy. You're on mute.
Yeah, I'm going to follow the pictures or the photos, which is easier. So Luis, can you go ahead?
Okay, thank you. Do you listen to me?
Yes.
Thank you. Well, my name is Luis Treviño. I'm the Senior Policy Manager at the Alliance for Financial Inclusion. So first of all, thank you for the invitation. We're really happy to share what we have been doing. And also we have a special guest from our membership, that is Mr. Stephen Jeboa from the Bank of Ghana. So he will introduce himself. But in the meantime, well, I am the Senior Policy Manager on data. So we have at AFI, at the Alliance for Financial Inclusion, for those that doesn't know the institution, it's a network of more than 100 financial regulators that, and we focus on enabling and promoting financial inclusion, right? So we have 7 different policy programs, and one of them is data. So, you know, the data work stream started 10 years ago. And, you know, to start, you know, defining financial inclusion and the concept, you need to start with setting an assessment of where you are in terms of financial inclusion. So we have been developing some frameworks and, you know, common ground among regulators for collecting data on financial inclusion. We have, you know, in our framework, the dimensions that we're more interested are access, usage, quality, financial services, and also, you know, and we have been going and evolving into more trying to assess impact or well-being, right? So savings, it's I think especially I think on the angle of usage is very important, right? We have set you know, some core indicators, especially on access and usage. This and we have been, you know, developing these indicators throughout the years on NAFI, right? Through the experiences, and we started with a very broad 5 core set indicators, and eventually we have been evolving the set of indicators to really touch upon specific policy needs, right? And well, savings, we don't have a specific indicator on savings, but we have many indicators that touch upon savings. And well, I think I can, you know, provide more inputs throughout the session. Thank you.
Yeah, we will. It would be good if we keep this part instruction short, because you probably were going to be talking about all these things in the first question. Ayako, please.
Hi, good morning. Nice to be in this working session with you all. My name is Ayako. I'm the Regional Manager Europe of MFR, previously known as Microfinance Rating. So I'm very excited to be contributing to the conversations from the raters' point of view. having conducted ratings, including social ratings and outcome measurements across the world. Thank you.
Stephen?
Yeah, thank you. Stephen Sasu Yabwa from Bank of Ghana, and I work at the Payment Systems Department and as a head of oversight and risk assessment, but previously with data collection and data analysis and reporting.
Thank you. Avisha? Not sure if it's...
Hi, everyone. Thanks for having me. Visha Singh, South Africa. I'm a customer strategist with a background in retail banking, specific focus on financial inclusion. My involvement has been with the CGAP team on the customer outcomes, looking specifically at creating an indicator set that is able to quantify customer centricity, going through the customer journey and bringing in the angle of the FSPs, having had a background in retail banking.
Antonique?
Yeah, thanks very much. I'm Antonique Koning from CGAP. I have led the Consumer Protection Project at CGAP for the last 2 years and have been working very closely together with Avisha Singh on a customer outcomes-driven framework for consumer protection and really looking at translating what customers need into indicators for businesses to track whether they're approaching better customer outcomes, and for regulators and supervisors to be able to verify that. And the reason why I think we're at this meeting is because even though the customer outcomes indicator framework that we've developed is product agnostic, we believe that there is a good way of looking at the set of indicators through the customer journey, as Vi just mentioned, to pull out the relevant indicators to show indeed quality, usage, access, as Louise just mentioned, for saving services, but from the customer's perspective. Thank you.
Thanks. Blaine, please. We can't hear you, Blaine. No. Not still. Maybe we can go to Céline and Cécile and go back to you. Go ahead, Cécile.
Hello, everybody. Happy to be here. Cécile Lapenu, Director of Cerise. We are working on social audit tools for microfinance sector, financial service providers, and now beyond the financial service providers sector, and collecting some result indicators, in particular through the SPI4. We have about 900 audits now, so have some information on volume of savings or accounts or type of savings. And we have been doing benchmarks on practices with the SPI tool, but we are also now doing benchmarks on some of the results indicators. So that's something that, and looking forward to work more on output and outcome indicators also around savings in particular.
Thank you, Cécile. Nitish?
Hi, I hope you can hear me.
Yes.
Okay, great. Hi, everyone. I'm Nitish Narayan. I'm from Microsafe Consulting, and I'm a senior manager here working with the banking, financial services, and insurance team. My role here has been to work with policymakers, regulators, and financial institutions, largely on financial inclusion strategy at a national level, and then with institutions on institutional strategy, both on the credit side as well as on the savings side. In addition to that, I've also worked on assignments related to digital financial services and financial capability development. And in most of these projects, there's a component of outcome and output measurement. So largely today, we're going to discuss about how this has been looked at, the problem of savings from a national perspective in financial inclusion strategies, and also from the institutional perspective in terms of customer centricity. So I look forward to the discussion. Thank you.
Veselina? You're muted.
Sorry. So I'm Vasilina Angelo. I'm with the World Savings and Retail Banking Institute, which is the largest global network of savings and retail banks. And there I lead Scale to Save. That is a partnership initiative funded by Mastercard Foundation that operates in 6 countries in Africa. And we are collecting data at WSBI level from the network globally. And we are also collecting data with the 10 WSBI partner banks, or let's say Scale to Save partner banks that we are working with in Africa. I already apologize because I have to leave at 11:45 to join a preparation session for another session that we're having today. But my colleague Celine, who's I hope now also in the room,
There, yes,
will be able to present WSBI then.
thank you, Vasilina. Dirk?
Yes, my name is Dirk. I have been an e-MFP member for the last 8 years. Yeah, 25 years of experience in banking and finance. That's basically the only thing I know. And I actually like savings way more than loans because it's, I think more people can access it than loans. I have been working for the Swiss Contact, the Swiss Foundation for Technical Cooperation for the last years, and also as a freelance consultant. Yeah, I sometimes feel like a lonely preacher and saying, yeah, savings, look at savings, and everybody's still focused on loans. So I see the challenges of measuring all the savings outcomes and impact. So that's why I'm here. Just to
Thank
learn
you.
a bit more.
Stephanie?
Hi, I'm Stephanie Garcia. I work at the BBVA Microfinance Foundation. We're a microfinance network with mostly presence in Latin America in 5 countries. Just to give an idea, we've got roughly 2 million clients and 1 million of them are savings clients. So we know the challenges that you're all facing. We incorporate every savings analysis as part of our financial health of our clients. And we've done some studies on it and happy to discuss further.
Thank you. Blaine, maybe now we can try if your sound is working.
Can you hear me now?
Yes.
Oh, thank God. Excellent. So Blaine Stevens, good morning, good day, everyone. Former COO at Mix, now independent advisor to, did I just disappear again?
No, it was a bit low, but it's better now.
Excellent. Now independent advisor to the Center for Financial Inclusion, the new home for Mix data capabilities since June of 2020, for those who have not seen. Wow, about 2 decades of experience in all things metrics. And I think for today's discussion, the piece that would be perhaps most interesting is work that we did a few years ago, looking at digital delivery to financial service providers, to clients, with a particular focus on savings and the metrics and what I could tell at that point in time. So happy to draw on that today.
Thank you. Celine?
Yes, I'm Celine, working as program manager for the WSBI and the Scale to Save program with Vasilina, and I'm looking at the data analytics of our program partners. I'm happy to be here.
Thank you. So, Deeptarag?
Hi, am I audible?
Yes.
Good afternoon, everyone. Sorry for not being on video, but I'm actually traveling, so I have a patchy network. Anyways, I represent Ujjivan Small Finance Bank from India. I head their family banking initiative, which basically targets microfinance customer and their families. And I take care of their saving program, as well as the cross-sell of insurance and other piece. And we, as a microfinance company, we are almost 15 years old, and we have a client base of close to 5 million. Recently, 2 years back, we turned into a bank, and now we are also started focusing on the same 5 million clients and their families for their saving habits. So we have our own internal matrix, but I'm looking forward to the session to understand how it is done across. Thank you.
Thanks. Aurélie?
Hi, everyone. So my name is Aurélie. I'm a researcher at the University of Bath, and I'm also a financial inclusion consultant. I work specifically on savings practices, mostly in West Africa, in particular on savings accounts, access and use in Ghana. Thank you.
Thanks. And we have Sam also joining us. So.
Oh, hi everyone. I'm really just stepping in and out between the sessions, but my involvement in savings this year has been largely through the Microfinance Award process. I am the lead author with Daniel, Joanna, and a couple of others on the paper that you may have seen announced at the ceremony. And some of the work that we did this year was on the difficult task of trying to actually measure activity usage in organizations that are very heterogeneous group in terms of capacity and size and location. Thanks.
So Daniel, do you just want to present yourself, or who can start?
Sure. I'll in fact
Yeah.
I will and also maybe kick off with a quick thought. I'm Daniel. I've been with e-MFP for some years. I've also, as a consultant and also at e-MFP, have spent quite a lot of work on savings and on research and on analysis. And so just the one thought I thought, to share as we kick off is, this is a session on metrics and how do you assess savings in an effective way. And there's a quote that comes to mind of a financial writer, I believe he's at Bloomberg, and he once wrote that metrics is like the evil genie. It gives you what you want, but only exactly what you want. So, if you ask to be famous and you find out that next day there's a viral video of you, but you would have rather not have that been the viral video. So metrics is exactly the same way. And there are many, many examples we can sort of look at. So with that, I'll pass it back to you, Joanna.
Okay, so I'm conscious of the time and that we don't have that much time. So let's kick with what have you been, what are you doing and what metrics are you using at this moment, and probably in a brief way or in a short form, so that probably we can pass to the second part of the discussion after that is what do you think is missing and what do you think we need to start working on to have these more specific and sector-wide metrics, and that can be useful for the whole sector. So I don't know if any of you want to start or to talk. Antonique, okay.
Yeah, I'll be happy to kick it off. As I already mentioned in the introduction, from CCAP's perspective, we've been looking at customer outcomes, and I heard Cecile talk about results indicators. Maybe that's more closely aligned to what we're looking at as well. We basically are looking at what the customer wants to do with the financial service in the end, and whether the services are actually meeting the purpose that the customer has. And so that kind of final purpose of increasing control over a financial situation, managing financial shocks, attaining longer-term financial goals. We have this notion that you can only achieve that if some of the other if some of the preliminary conditions are in place, and some of the factors that we are looking at are, suitability of services, whether there's choice for people, fairness and respect, whether people are treated in the right way, whether they have a voice in interacting with the financial service provider, and whether their resources, their data, their money is safe and secure. So those are kind of five kind of basic ingredients that we feel need to be in place in order for services to meet the customer's purpose. And this may sound very high level and generic, but I think it can actually be applied quite nicely to saving services. And so what we've been looking at is what are the kind of proxies that you can look at that are in the realm of the financial service provider. So data that is being gathered by financial service providers that can give you an indication as to whether the services, saving services in this instance, are actually geared towards having a positive outcome for those customers. So whether these services are indeed geared towards meeting the purpose that the customer has with this particular saving services. So we've been looking at these aspects from what the customer needs, looking at it from the customer, but then combining that with different business functions that exist within financial service providers and looking at particular indicators, composite indicators, data points that are already available within financial service providers to be able to say something about that. And so what we did for this particular exercise today is we looked at the vast majority of the indicators that we have boiled down into 20 top indicators for regulators and supervisors, as well as the financial service providers to track this and see which of those top 20 indicators might be relevant to look at through the customer journey to see if indeed those services and the engagement with the financial service providers for these saving services are setting them up for success. And so let me just maybe pause here and pass on to V, because we have a slide which maybe I can just quickly show that she can talk to, which is reflecting the indicators that we actually think might be the most relevant for this discussion. So V, why don't you speak to that? In the meantime, I'll try to see if I can share that screen, and you should be able to see those now. Can you see the screen?
Yes.
Yes, Angelique.
Thanks, Angelique, for that intro. It was resonating already in people's introductions, the things like your dormancy and digitization, and basically having that platform that FSPs will have in place. So without going into or just reading on the slide, we're welcome to share this with you. From the top 20 that Angelique mentioned, I do need to mention that it's comforting to hear that there was a journey. We started off with something like 189 and broke them down into quantitative and qualitative. And the top 20 are basically, as Angelique mentioned, those that resonate with a composite outcome called meets purpose. Because in the meets purpose, it is composite indicators that try to measure whether the customer is better off or not as a result of engaging with a specific FSP. So with lots of refining and getting feedback from FSPs, including the South African regulators, we identified approximately 8. There are a few more at a stretch that have a very good alignment with savings, but bear in mind that I think it was Daniel that mentioned this. Our indicators are product agnostic. So these are the things that if you have to follow the customer journey, the first thing that an FSP needs to do is, in any organization, have an understanding of the customer, and specifically when it comes to financial inclusion. So South Africa's had this focus, I'd say very strongly in the last 15 years, and then it plateaued in terms of after we banked the unbanked, what do we do now? So the first thing that we look at is the financial vulnerability. We have things like indices in the country, but also FSPs track this information fairly well, because there are things like quality and risk grades that have to go into assessing whether the customer is suitable or viable in terms of the risk and compliance that they do. This is a beautiful indicator. The second one that sits in there is information that is collected already. We know exactly how much we're earning from a specific. What I do need to mention is all these indicators are segment specific. So however you break your customer book down into it, it's income, demographics, hopefully not race, but these are understanding it at a customer cluster level. So what is the proportion of revenue versus the income earned? So a calculation of a customer's median income and a percentage of it. We've stayed away from hard figures because they tend to be meaningless when we start to aggregate. We found that a useful proxy. Now, if you can keep the head of savings, is that if you understand who's vulnerable and you understand your proxy with fees or the charges and interest, you already know within your group who, at the want of a better word, your target market is. So you can see where there's disposable income. You can see where there's a propensity to save. What I do need to mention is that our indicators are very focused on the FSP's ability to control these factors. So extraneous variables like, the economic climate and propensity to save because they can't control sort of lifestyle and life stage events. We needed them to only focus on that which they can have in data repositories or in financial reporting or strategic intelligence. So when looking at the product relevance and longevity, that's when Antonique mentioned something like suitability. It starts off with the product design, I apologize. It starts off with understanding the customer and designing according to insights, research, quantitative evidence, not just pushing what's in the market at the time because the margin is high at that time. So developing and designing products and solutions, and this includes your digital platforms and how customers are accessing it. So what we looked at that might be quite relevant to this discussion, and a very contentious one, is your cross-sell. So cross-sell ratio it's a double-edged sword. It can either be seen as mis-selling because you're just trying to up the number of products without understanding the need. So we caveated it, not caveated, we've either supported it or added diagnostics with this to ensure that it's cross-reference. So if you look through it, we've touched on dormancy, unclaimed balances. So I'm just going to maybe focus on the two. Basically, your dormancy story and your cross-sell, your dormancy story and the unclaimed balances. This is quite relevant to this discussion because we're also suffering with this inability to understand who's left accounts with balances in it. And in the absence of regulation, FSPs are well within their rights to erode those balances with fees. So when somebody does come to claim it, there's nothing left there. And it's a big problem with third-party attorney accounts and deceased estates. I'm going to hand over from here, but the detail is there in the green indicators on the share screen, which I can't see right now. The green indicates that this data is being collected. The orange is it might be collected, but not orientated. And red is very aspirational because we are nowhere near there. Well, in our context right now.
Yeah.
Thanks,
you. Thanks, Avicha. So can you stop sharing? So anyone wants to jump in now?
I'll step in if you like.
Stephanie, yes,
yeah.
please. Good idea.
I think
the FSP.
I think and I'm not sure if you had something in mind in terms of the agenda, but for us and the way this is one perspective, right? But for us, the way we look at savings accounts, and we've got sort of different departments. I'm talking from the impact angle, so maybe we should have another team next time. But for us, the savings is important just because it's one of the main products to improve resilience, right? And that's really how or what we're looking at. So the question really then becomes is, what is a good savings client? How do you define that, right? And how do you measure that improvement over time? Which goes to the point on dormant accounts. So when we look at, so we've done a couple of things, and I think with COVID, we've come up with another set of challenges. And I don't know if I can briefly just share my screen real quickly, because what happened this year will change most of our analysis going forward. So what we did is planning and saving is one of the big elements of financial health for our clients. We classified our clients according to their financial health and savings. Savings, of course, a big element of it. But what I wanted to show you is, and probably every FSP has this number, this is our bag of clients across the globe and in all our institutions. And I'm sure Ujivan has similar numbers and probably in Ghana as well. What you tend to see is the majority of your savings clients have very small balances. And when you look at the indicators, there's so much disparity, and I understand the point on means, but we really struggle to define, what is a good number for savings balance? How do you measure that across time? How do you, the effort on the point on vulnerability you were speaking about earlier, how do you measure that? Because the numbers are very difficult, I would say, to find, right? So you've got 80 in our case, 84% of our clients have 16% of our balance. So you can argue, the number of dormant accounts, these are probably all our dormant accounts, right? Then there's 9% of our clients. So this 7 plus 9, those are clients. So it's a roughly 80, almost 20%, let's say in a positive case. 20%, let's say 16% of our clients are clients that have some sort of savings product, or clients that have been credit clients in the past and therefore small income client, low income clients, and they have larger balances, right? So there's a better correlation here. And of course, the 7% are really the savings only clients, and we've excluded institutional clients here, of course. This 7% are clients that hold deposit accounts mainly, and they've got 78% of our balances, right? So these are the numbers you're working with. And when you realize this, there comes regardless of methodology and regardless of how you define this, when we look at this over time, and we've done a couple of analyses, and you can see them here, happy to share in terms of savings amount, or correlation with different types of profiles, propensity to save in different types of angles. We've done this, but then we said, well, the true point about this is realize our clients don't really save, right? At least not with us. And that's really the challenge. So we looked at a specific savings product, for example, in Dominican Republic, where we said, okay, well, let's see if they actually meet their targets. So these are savings amount for specifically targeted, because as you all know, there's been a lot of research on savings products, right? And one of the main issues here is that you need to have a target, especially for low income people. I'm taking aside now the larger clients that do have a big savings amount. I'm talking about the real low income client. That's the one you want them to increase savings, right? So we said, well, these clients tend to have irregular savings, very small amounts. And so for us to see if they're actually meeting their targets, you can ask them, of course, but what do you have in your database that you can use? So we said, well, these are segregated for gender. So we looked at the average balance. The line in blue are men, the lines in blue. The lines in shattered, the non-straight lines are women. We compared 2018 to 2019. This was last year's report. So this 2018, the straight line is 2018, and the orange are women, the blue are men. And so you see that in 2019, women were doing much better in terms of their savings amount. They tend to do, and men as well, for this savings product. This was a specifically targeted product for 12 months. They had to save a specific amount each month. So it wasn't a deposit, it was a savings account where they were encouraged to save. They had reminders every month, et cetera, et cetera. So the typical savings product that goes to a targeted client, where you incorporate all lessons learned, right, that we've had from over time. And so we saw that when we looked at these numbers, the reality was that about, so the target was you need to be at least 12 months to have a good savings amount. And then we realized that here, the numbers were slightly higher in 2019. So that was a good indication. And then when we looked at it over time, we saw the savings amount increase, but the number of clients left, right? So those that remained, which were very little, had good numbers, but most of them left. So when they met their target, they left, right? And that's mainly because, and these numbers, they're averages, right? So if you look at the medium, it's significantly lower. But then what we said, well, so they do manage to save, and they do have interest to save, right? So the thing is, it's not only product design, but how do you increase this over time for a large number of clients? So here we're talking about very, very small numbers of clients. And we realized that this is definitely not easily replicable in other countries. And there's a lot of elements about, and Anthony spoke about those, suitability and security, et cetera, et cetera. So the question for us now became, and if you look at these, at the initial numbers, how do we shift this 9% to this, how do we increase these numbers, right? How do we make sure that these 9% of our clients that are the real savers, if I may, to be a much larger number, to be this 84%? And how do you measure that across time? Because the numbers that we show were for a specific product, but when you look at your entire client base, it's much more challenging. So for us, there's, first of all, how do you define that? That's the first question for your aggregated numbers. And then the second question is, and that's something we realized with COVID when we did our surveys, our clients save quite a bit. And we know that from first surveys we've done 2 years ago and the surveys we're doing during COVID right now. But we don't know how much they save because you don't have national data, right? So a lot of the informal savings is there, probably in other financial institutions, working at numbers in Colombia as we speak, but most of the savings are in informal sectors, and we don't know about that. And so our challenge now becomes, how do you think about a savings approach that is that is fair, in the sense that you can't say that because they're saving more with you, they're actually saving, because in reality, the household may not be saving, right? So you don't have that data. So we're at crossroads currently, trying to look at how we can increase resilience in terms of course, the crisis is not helping, but how can you increase resilience and how can you measure that objectively without having, or with having very, very bad data in reality, actually?
Stephanie, can I just jump in for a second? So two questions and maybe thoughts. One is, all those. So the second set that you were showing with a chart that had the line graph, those, as I understand, were some sort of goal-oriented savings accounts, right? Kind of commitment style. And then the first set was just all your savings accounts, right? Including so. On where you're looking at all the accounts, in the MIS, you have data that would be able to, for example, see how much money is flowing through the account. So you can look at turnover, even if the average balance may be low at any one time. Maybe they're actually using for a lot of turnover. You could even go in and say, oh, let me exclude any loan proceeds, because you can see where money is going from one account to another, right?
Yeah.
And so this can be meaningful. I don't think we should make the assumption that clients must necessarily save to accumulate over time. That is one way of saving.
Yeah.
But what I mean is the underlying data is there. It's just, how do you look at it in a way that it's meaningful?
Exactly. And we've looked at both angles, as you said. So we looked at, and actually we're doing that now during COVID. And there's the irony that during COVID, our savings amount have increased, absurd amounts with retail clients. And again, I'm excluding institutional clients. And there's, something I guess we're missing, because from our surveys, they say that they're actually using their savings to cover up for the crisis, but our savings amount are increasing. So like, there's something I'm missing here. But what you're saying, yeah, we did do that. Of course, there's the difficulty about, as you say, the cash transfers, et cetera, it's hard to filter, but yeah, we've looked at that. But you end up with so little number of clients. I mean, I'm, in the best case, from my 1 million, in the best case scenario, I remain with, 30,000 clients.
Yeah.
That's great, right?
Meaning the rest are dormant. That's what you mean.
Yes. Or I don't know what's happening with them. And so the thing is, those remaining 84% of clients, it's not that they're not saving, they're just not saving with me, right? That's the real point. And in the end, what you want to do is improve that. So you don't want to measure savings. I mean, there is this regulator or sector angle about liquidity and liquidity management, which is, that's why I was just asking at the beginning, that depends on which angle we look at, right? But if I ignore that angle for a second, it's how do you actually ensure that you shift that, how do you make sure that those dormant accounts actually start to be used? And there are a lot of elements in there, right? Access to the sources, reminders, products that are better suited, et cetera, et cetera. But the clients, in the end, they continue to save informally. They do. And we've done education, we've done trainings. We suggested to some governments to incorporate those trainings because they're not financially sustainable for us to do. And the government just, didn't listen, because of course this is expensive. And that's where the sector effort goes, right? I'm not going to the sector effort, right? But even in our own institution, how do I ensure, we've segmented our clients, we've gone to them, we've encouraged savings products, they won't take it up. So again, there's a lot, cross-selling. I hear your points on cross-selling. We did cross-selling. Of course, if you have more products, you've got more client loyalty, they may be interested in savings product, but they tend to, it's the loyalty in savings products is really low. The savings amount, again, are really low. You're looking at a very small niche kind of client, and I really don't believe that's the case. So I feel that maybe it's us, right? But I think that we're missing something here, and that we could do things better. I just don't know yet how.
Maybe we can hear Deeptarag on this, and how is their experience in India? Is it similar to what Stephanie mentioned?
Yeah, I could relate a lot to what Stephanie was actually sharing through her data. What we found interesting during our interactions, because like I said, we started with a loan relationship, and then we kind of migrated the relationship into a saving account. So it was a different kind of a sales. It was not a saving account leading to a loan, but you start with a loan relationship based on the credit history. If you come back for a repeat loan, which means you have this ability to service debt, we also give you a saving account now so that you can parallelly build your savings. So I think the similarities that I saw with Stephanie is there is a very niche group which kind of uses that ability or that opportunity to save. But on the other hand, there is a large chunk who gets a savings account, but they're not really interested in saving with a formal scenario like a bank. Their savings are mostly local, and from what we realized that when we started looking at traditional banking matrix like dormant and inactive, that would never give us the right connect with the kind of customer profile that we are serving. So we have kind of changed the matrix in order to understand that is accessibility a key factor when people are saving. So people whom we are meeting on a regular basis tend to save more, and where there is an active engagement of our employee. On the other hand, if there are these soft nudges like a phone call, like a SMS reminder, then we leave it up to the client completely on whether they're willing to save or not willing to save. And those kind of clients would a large portion of those clients would move into becoming an inactive and a dormant, having an inactive or a dormant saving account. So I think accessibility of the saving. So just by providing a saving account, it didn't help us. We brought in goal-based deposits, which I think there is a outcome to which the customer is aligned and wants to save. And also we have now started measuring that is our interaction leading to saving. And I think that is giving us an upside in terms of how we are seeing behavior change across our customer segment.
May I ask, Diptarag, did you have feedback about trust? Because one issue that we struggle with is a lot of our clients, they don't really say it, but when we've asked our credit officers to speak with clients, they actually don't really trust the bank, right? They have this, especially in Peru, for example, for some reason, there's this feeling that, you know, you shouldn't leave your, your money in the bank. I don't know if you had that same issue and how you dealt with that.
Yeah, so we had that issue, and one of the reasons why how we tried to address it, and the approach that we have taken is the same credit officer who has kind of serviced them for a period of 4 or 5 years, who has been in their area. We have kind of given them the additional responsibility of bringing in complete financial inclusion, and the ability that a former credit officer is now a complete banker and is able to give both ends of financial service, a complete financial service or banking service. For example, that same person is now able to give loans if the client demands it, is able to provide a savings account, is able to provide term deposit services and also insurance. So this is one person who has this entire basket of services. Rather than the traditional bank, what they do is they have different departments and different people going and interacting with customer. So I trust one person because they have come to my aid when I needed a loan. But I don't trust the other person because he is coming and just asking me to save with him or her, right? So I think by having this one common point, servicing every area and that particular clients of that particular area, I think we have had a slight breakthrough or a better understanding. So in Ujjivan, just to give you a breakup, there is 2 complete division. The micro banking division takes care of end-to-end banking services. And there is a proper retail division that goes and only sources saving clients. So having these 2 divisions has helped us in how we have approached clients.
Thanks, Diptarag. We are getting close to the time. So I would like to have or Louise or Stephen to bring us the regulator's perspective as well as before. So what do you think?
I would invite Stephen, please.
Okay. Yeah, thank you very much, Louise. we will take it from the regulator's perspective. As you've said, for regulators, most times we focus on the supply side data collection. And also we look at the granular data also. So we collect the data to address or measure financial inclusion and also to support monetary policy formulation and also provide government with data for economic analysis and social intervention analysis and also for evidence-based policy. So when it comes to the area of the savings, we normally open it or collect a broad data, that is a deposit. So if you collect the deposit, then the template we develop, the template will capture either a demand deposit or savings accounts or time deposit or any other deposit related account. So we get to the financial service providers and we give the template. We discuss the template with them, all right. So the template will take some data indicators like the customer ID. Now we've put the customer ID inside just to prevent double counting because the data is coming from different financial service providers. So if you have the customer ID, then you can easily use a unique identifier to prevent double counting. Also, we pick data on, say, classification of a depositor, whether the depositor is non-resident, resident, and we pick on the date of birth also to help us to get the age dimension. And we pick on the gender for financial inclusion purposes. And we pick also regional distribution. So we get a regional dimension and we pick on the type of account, whether it's, as I've said, demand, savings, time, and whether the account is also a joint individual. And then we pick the outstanding amount. And then the status of the account, whether the account is active, inactive, or dormant. And here we need to have a definition for each of the category. So if it's active, then you have to give a definition. If it's inactive, you have definition. Dormant, you have a definition. So one, if you have the template, like an Excel template, and the service provider, the financial service provider need to indicate each customer, then on the template, he can pick on all these indicators. So when the data comes to the regulator, then the regulator can use analytical tools to put the data into stratified manner, such a way that we can do proper analysis for that. So for here, this is where I'll end for now. Yeah.
Luis, maybe is this something that you see across the board or on your partners, or is it Bank of Ghana that particularly works on this?
No, of course, I think the supply side data, the data from financial service providers, it's very relevant for policy maker purposes, and also to also the act of sharing these templates and agreeing on the structure with the financial service providers, especially thinking about sess disaggregated data, that it's quite relevant, right? It brings an opportunity also for the financial service providers eventually to also even many may already have their analytics to also think in new ways, right? To segment the data that they have, right, from their customers. Additionally, also, the demand side data, it's important, right? So, but it's more costly, right? But demand side data can also provide policymakers and other stakeholders with the overview, not only on specific customers, formal institutions, but also what is the landscape, right, in terms of savings and credits. And as you mentioned, it provides you with the clarity and of which are the clients that actually are savings outside of the formal institution. So I think both, and you know, from the policymakers' perspective, both data sources are relevant. Demand side surveys are quite costly, so and so it's less frequent, right, to collect. But increasingly, I think on our network, almost everyone has developed some kind of demand side survey, additional to the ones that we already have, right, from the World Bank as the Global Financial Index and other sources. But you know, the advantages of national surveys is that they are tailored and they're focused on policy and are much more granular, right, to inform policy makers, especially thinking on financial inclusion strategies, right, and keeping track and evaluating. You know, demand side surveys are an essential component, right? And well, but actually, you know, what Stephen has shared, I think it's quite all the policymakers are right now doing, and that's why in the AFI network we have been developing these different indicators, right, to provide some common ground, no, for this this data collection and sharing between policymakers. So yeah, I don't know.
Thanks, Luis. We are very close to the time of to end this session. We're sorry that a lot of you didn't have the chance to share. I think we were all very ambitious on what we could accomplish in 1 hour, but we hope that this is just the beginning, and so that hopefully we or any other of you that is here, we can continue this conversation and schedule probably a workshop or that can have more time and then can give us more time to discuss all this. So anyone wants if anyone wants to say anything now, just as final remarks, please go ahead. We have still a couple of more minutes.
So if I may come in, Joanna, I just want to make 2 comments.
Yeah, sure.
Yeah. So the first is, you know, from a policy perspective, and we have some examples from India's financial inclusion, flagship program called PMJDY, and we've seen that, you know, it's good to choose metrics, but if the metrics are not dynamic enough, then it can lead to problems. So when the program was launched in 2014, the policy objective was to increase bank account ownership. And the metrics that were designed at that time were focused largely on bank account ownership. So there's weekly reporting of number of new bank accounts opened, number of bank accounts owned by women, average deposits, etc. And I think by 2016-17, everybody started realizing that the number of accounts opened have increased, but the balances in them are not there. And suddenly, there were surveys done and there were reports coming out. Bankers also realized it. They started putting 1 rupee into those accounts so that those accounts are not empty anymore. So the challenge is that from a policy perspective, how swiftly you can change your metrics so that once you've achieved an objective, how can you quickly move to the next objective, which in this case is usage and quality. That becomes important. And from a provider perspective, you may look at account balance as an important indicator, but the fact is that the money management of a household is much more complicated than what we imagine. And putting it under the larger bucket of just increase in value of deposit, it's not going to actively or exhaustively cover the kind of financial lives that some of the target segments are having. So those metrics need to reflect the dynamism and the diversity that we see in the customer segments, and should not just be limited to, say, the account balance or the number of transactions. Yeah, I'll stop now. Thank you.
Thanks, Nitish. I think we are really on time now. So Dirk made a very good proposal of starting an action group on the savings, which is something that we are going to seriously consider, and probably will reach out to you to or to some of you to think a bit more about this, and then maybe get a space where we can further develop this discussion. So if anyone else wants to do final remarks, I think we have like 1.5 minutes, so please go ahead.
Just maybe saying thanks to you for drawing the attention to this topic and for bringing us all together. I think it's a worthwhile effort. So happy to continue to support it.
And from what I hear, we have plenty of data. It's really making sense of them and guiding FSB and their management to use them on the most efficient way, and reporting to regulators and making it useful for the external stakeholders. So maybe not a big deal of finding new metrics, but helping in using them.
Ayako, you wanted to say something?
Yes, just one sentence. I'd like to encourage all of us to think that if we all agree that the final objective is to create resilience and ensure that there's more security for the final clients, then we should broaden this conversation about outcome measurement to the whole financial ecosystem, including remittances, paygo services, because they go hand in hand.
Yeah.
Yes, but that'll take yet several more hours on top of that. But you're absolutely right, Ayako. I think what I would, I think it'd be nice to focus on something, you know, the lowest hanging fruit, the most tangible stuff, which I think the one sense that seems common is there's a lot of transaction data that FSBs already have. And it's, can we kind of aggregate and find ways to analyze it more and then add on additional layers, exactly as you say, Ayako, remittances being received that are going through accounts or being sent out from accounts. All the stuff is available. So I think you can kind of grow from that foundation. But right now, the sense I have is even, for example, Stephanie, the reports you shared at the beginning, you have a lot of data and you show some of it, but you're still quite limited and still mostly looking at averages, mostly looking at, right? And I'm
well,
sure
I don't publicly share that.
Sorry?
I don't publicly share that.
Well, fair enough. Next time you can share the non-public stuff. All right.
I was just wondering, I know that CFI has done a lot of work on this as well. Have you thought of including them in the conversation?
We would love to get it. We're in touch with CFI.
It's a bit early in the morning for them.
Yeah, I know. Fair enough.
We're in touch with them on many things, and we'd love to include them in this. And I think Financial Access Initiative has done some work on this as well. There's work out there. Absolutely. Yep. Thanks for that.
So I guess we say bye-bye to everybody. Continue enjoying the week, and well, hope to see you all of you very soon on the conversation, to continue the conversation.
Nice to see all the faces. I like the Zoom sessions.
All right, thank you, Cecilia. We definitely want to continue this conversation. We're seeing it. We really see this as a starting point, so you'll be hearing from us.
Yeah.
Thanks, everyone. Enjoy the rest of the European Microfinance Week.
Yeah.
Bye.
Thank you.
Bye.
Thank you. Bye. Thank you,
everyone. Bye-bye.
Thank you so much, Stephen. Thank you.
Thank you.
Thank you for sharing.
Yeah, thank you, Luis. Yeah, thank you for the opportunity.
Give my regards to everyone in Bank of Ghana.
Okay. Thank you.
Bye.
Bye.
Bye. Thank you. Daniel, thank you.
And now, bye.
Joanna, really good moderating. Thank you.
Thank you.